Hi everyone. In the previous video, we learned how to decide which stock category to trade by choosing between different market caps and floats. In this lesson, we will hone in more on the methods used to pinpoint which company's stock to trade. We will talk about the different types of stock analysis techniques that traders and investors use to build their case on whether to go long or short. There are two very popular stock analysis techniques known in the stock market world: fundamental analysis and technical analysis. Both are widely spread and each has its proponents. Each has its advantages and disadvantages, and each is suitable for a certain type of trader, whether that be swing trader, day trader, or long-term investor. Let's start with fundamental analysis. Fundamental analysis is a way of judging a stock's intrinsic value based upon a company's financial performance, its expected future growth, its competitors' performance, and the overall market and sector conditions. Fundamental analysts try to profit off of the inefficiency in the market price of a certain stock, whether that be undervalued or overvalued. They do that by assuming that the price will have to eventually move towards that intrinsic fair value that they calculated. Hence, they buy or short at that inefficient price and expect the stock to move to their price target. These expectations are often met, but sometimes take very long periods of time, and even sometimes they never happen. That is why fundamental analysis appeals to long-term investors that can wait for months or years and hold their positions through all the stock price fluctuations, hoping to reach that final goal. I will not go through all the different methods and factors that the fundamental analysts use to judge a stock, like for example the PE ratio, the book value, EPS or earnings per share, and the growth rate, as this course will focus primarily on short time frame trading, namely day trading and swing trading. And in those time frames, pure fundamental analysis plays little role in determining if we should go long a stock or short it. Okay. For a long time, up until the 1970s, fundamental analysis was considered to be the only rational and professional way of analyzing the market. Technical analysts were regarded as fools that don't know what they're doing. However, fundamental analysis has one very serious weakness when it comes to analyzing a stock value. That is, it fails to account for human emotions. You see, even though calculations might determine a stock price to be at a certain value, this doesn't necessarily mean that it needs to reach that value. This is because the market is not 100% efficient and traders are not computers, they are human beings that judge sometimes through emotions. That is why a stock might be fundamentally classified as junk, with a very low intrinsic value, yet the price continues to rally higher and higher because the collective trader's sentiment is driving it upward. Maybe traders think it is going to be the next big thing, or the management came up with some impressive press release, for example. Whatever the reason might be, in short to intermediate term, a stock price may go completely opposite to a fundamental analyst's calculations. Okay, so what does technical analysis bring to the plate? Technical analysis assumes that all information you need to know about a stock is already factored in its price action. Everything from fundamentals to emotions determines a stock price, and all you need to do is to trade on the right side of the price action. Their motto is, the market is always right. In other words, pure technical analysts don't care about the stock fundamentals at all, and they base their decisions solely on how the stock price is moving. That is, its technical chart. They use trend lines and technical indicators on price charts and have identified certain patterns that predict to a certain degree of accuracy if a stock will move up, down, or go sideways. This method has dominated since the 1980s for short to intermediate term trading, and even some long-term investors use technical analysis to pinpoint their entry into a stock and choose their exits. Books have been written about the subject, and people have spent their careers mastering the technique. Fortunes have been made using this method in relatively short periods of time. It is now regarded as a very powerful stock analysis technique. A drawback, however, of pure technical analysis is that it only uses charts to judge a stock's performance. This can sometimes be misleading and can lead to several problems. It can be subject to stock manipulation. An example of such manipulation are pumps and dumps, where a stock is hyped or a certain entity ignites a buying mania through buying a huge number of shares and creating a false demand and a false uptrend. Then when the other traders jump in and drive the price even higher, this entity dumps all its shares onto those unsuspecting traders, causing the price to crash right back down. This could be a problem, but fortunately enough, it seldom happens in the Nasdaq and the New York Stock Exchange, and if it does occur, it only occurs in very small cap stocks that can easily be manipulated. However, it does happen a lot in the OTC market, and if you are on the wrong side of the pump and dump, you better be careful. Okay, one thing to note here is that you can be successful using either method of analysis. It is a matter of preference. Warren Buffett, the super famous billionaire, is a value investor who relies on fundamental analysis. His famous quote is, "Price is what you pay, value is what you get." On the other hand, Marty Schwartz, one of the most famous technical analysis traders who ran his accounts from 40 grand to over $20 million, used to work as a fundamental stock analyst before switching to become a technical trader. And when asked about it in 1984, he said, "I used fundamentals for 9 years and got rich as a technician." Okay, so now that we have understood fundamental and technical analysis and have seen their strengths and weaknesses, there seems to be another type of analysis that is starting to become very popular among traders. It is a mixture between fundamental and technical analysis. It tries to capture the best of both worlds. It's based on technical analysis, but the choice of stocks is on fundamental criteria. So as opposed to a purely technical analysis standpoint, which bases its selection of stock only upon the stock's price chart and volume, this kind of analysis first looks for stocks with a good fundamental mover, like good earnings or some sort of good news or analyst report, then looks at the chart of that stock and decides whether it is tradable or not. In other words, fundamentals are used to choose a stock from the available pool of 3,000 stocks, then technicals are used to determine if it satisfies your setup criteria and worth trading or not, and to determine the bias, meaning long or short, and the entry and exit points. This kind of analysis is the one I am going to endorse moving forward in this course, and in the next video I will discuss the different types of fundamental movers, also known as catalysts, that can cause a stock to move up or down. So stay tuned, as this will be a very important one. Thank you and see you next time.